The person who, scenario 2, who had a good run for the first few years, ended up with 112,000. And in the scenario where you had a bad run for the first few years, they ended up with a lot less. So what's important to understand is the returns are real once you withdraw them out. And the other thing is, if you have bad years or down years, what is your backup strategy to try to eliminate or minimize taking money out during down years?
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hello, everyone. My name is Mike Ross, and I'm an advisor with IBC Group. And today I'm going to talk to you about sequence of returns. We'll go through what is sequence of returns, money versus math, the impact of sequence of returns before and during retirement, and some strategies to reduce sequence of return during your retirement years. So as we start off, we're going to talk about money versus math, and this is the actual versus the average rate of return. And what's important to understand with money is that money has erosion factors. It has up to 16 erosion factors, and one of the erosion factors is the ups and downs of your returns from year to year and the volatility with your portfolio. So a lot of financial institutions and entertainers, they talk about average returns a lot, but the world that you live in is the actual rate of return. So if we take a look here and we say, let's say you put $100,000 in, and we're using an extreme situation here. And in year one, you made 100%. So your portfolio would now be worth $200,000. And in year two, you lost 50%. Now your portfolio is going to be back to actually $100,000. So if you look at your average rate of return, 100% minus 50% divided by 2 is 25. And a lot of times that's the figure that you're going to see when you're looking at average returns, whereas your actual return is actually 0%. So the order in which your investments occur is what the actual sequence of returns are. So if we're taking a look at 3 different scenarios here, this is a marketing piece by a financial institution in Canada. And they're just showing if you had $100,000, what your portfolio might grow to and what it might look like if your sequence of returns was in year 1 all the way through to year 10, straight 7%. Then in the second scenario, they're showing a wide range of sequence of returns. And then in scenario 3, it's the exact opposite of scenario 2, starting from year 1 and reversing year 10. So if we take a look here, you're going to see that this portfolio ends up in the exact same position at any point in time. So it doesn't matter if you made a straight 7%. It doesn't matter if your portfolio went way up and down and you had the exact opposite returns, you're going to end up in the same point. The problem when you look at this scenario here, though, is that how many people out there are going to invest $100,000 10 years before their retirement and never invest again? And that's very unrealistic. So what we're going to do here is we're going to test sequence of return. Is sequence of returns important before retirement or just during retirement? So what we're taking here is the Dow Jones Industrial Average from 1990 to 1999. And as you can see, the returns are quite phenomenal over this 10-year period. You have only one down year, and that's your first year. When we look at the scenario, so let's just say, for example, instead of the 100,000, let's just say, as most people would do, they don't have 100,000 just to put in. They might be only putting in 10,000 or whatever that works out to a year. So we're working out this exactly the same, that here's another client that put in $10,000 a year. They put in the exact same amount of money over that 10-year period. And who's going to end up in a better position? So if you take a look on the left-hand side, you'll see the $100,000 deposit, and where this client ends up after 10 years, they end up with $417,000, as opposed to the client who invested $10,000 a year, ended up with $284,000. So in this scenario, client that deposited the $100,000 up front has done significantly better. So then if we run things out to 2000, and we now take 2000 to 2009, so another 10-year history, and you'll notice inside, using the Dow Jones Industrial Average again, it was a lot rockier ride for the Dow during this 10-year period, and there's actually two major market corrections, and there's 5 years where the market's actually lost money. So if we take a look at and apply this, this is the exact same scenario. Someone investing $100,000, the person says, well, I did well when I invested the 100,000 for the first 10 years. I'm just going to invest the 100,000 again. So if you take a look on the left-hand side, you'll see that that person that invested 100,000 ended up with actually $90,600. So they actually ended up after 10 years with less money than they started with investing in the Dow Jones for that 10-year period, compared to the 417,000 they made the 10 years prior. And then if you take a look at the 10,000 person that put $10,000 deposits in per year, they ended up with $99,000, almost $100,000. So they almost ended up $10,000 better than the person who even invested the money at the beginning of the 10 years. So you can see here in the scenario that the client in a down scenario actually did better over that 10-year period. Now, the other thing to keep in mind is if the client is continuing to make contributions past this stage, that they will probably continue to do better in that second scenario because they bought so much at a lower price point, being they were buying in a lot of $10,000 annual deposits while the markets were actually going down and correcting. So what is the difference between the best and worst case scenario? If we take these four scenarios and compare them, it's actually the person who deposited $100,000 between 1990 and 1991 on the right-hand side ended up with the best return. And the worst return was the person who actually did the exact same thing 10 years later and ended up with $90,000. So in this scenario, you can see the exact same sequence of returns that has a lot to do with when these actual returns are actually deposited before retirement. It's not always the sequence of return itself. So in this scenario, during a declining 10-year term market, or when you had lots of market corrections, you probably will do better off when you're actually putting in regular contributions as opposed to a lump sum. If you're in a 10-year period where the market is just soaring and continuing to go up and very little market corrections, you're probably going to do better with just one lump sum. Of course, no one can predict what's going to happen over that 10-year period. That's the big item that people have to try to figure out. So when we go through the sequence of returns during retirement, it works very different at retirement, because the big thing to keep in mind at retirement, the two big risks is one is that when you actually withdraw anything at retirement, anything you start withdrawing is an actual real rate of return. Then anything before that rate of return, until you actually physically use any money in your portfolio, all your returns are just returns on paper. They are not real returns. You could say I made 7%, I made 21%, I lost 21%, whatever that is. Nothing is real until you physically take that money out and use it. So in retirement, you're going to actually start to do that. So you're going to start actually claiming some of these actual real returns. And the second thing you're going to notice here as we take a look, and this is the exact same scenario as the accumulation stage, except this is the withdrawal stage. The person who made 7% ends up, of course, after 10 years with $100,000 because they withdrew 7% and they made 7% every year. The person who, scenario two, who had a good run for the first few years, ended up with $112,000. And in the scenario where you had a bad run for the first few years, they ended up with a lot less. So what's important to understand is the returns are real once you withdraw them out. And the other thing is, if you have bad years or down years, what is your backup strategy to try to eliminate or minimize taking money out during down years? So the other item we sort of have to take into consideration here is when you're looking at these returns and you're seeing 23%, for example, 21% rates of return, keep in mind when people go into retirement, this is also maybe not a fair comparison in the big picture when you look at just this marketing material, because a lot of people are going to be a lot less risky at retirement than they will be 10 years before retirement. So it's not likely you're going to see 23% rates of return and 20% rates of return, because you're going to be in a portfolio that you really probably don't want to see as much volatility for the most part, or at least that's the case with the majority of people. So just to walk through what are some of the options to reduce the sequence of return risk during retirement. So we want to minimize withdrawals during down markets. Every strategy, keep in mind, has pluses and minuses. It doesn't matter what it is out there, what product, what strategy it is. Every strategy is going to have a positive and negative. You have to take what the best parts of those are out of that and see if that applies to your situation and it outweighs the negatives. So I just put a few strategies here together. First thing is the cash wedge. If you've been saving for your retirement, cash wedge is designed to minimize market volatility when making withdrawals. So what happens here is you make a withdrawal you take enough out in cash in year one to make a full year of the withdrawal of income. And then you want 2 other years of money in GICs or low volatility funds, so very low risk, for 2 years. So you basically have 3 years of little or no volatility with this money. And then the rest of your portfolio is going to be matching your current portfolio risk of whatever your current risk is there. And that's a way to sort of minimize taking money out during down times. Another way is to buy an annuity. Annuity is basically just exchanging your money, giving it to the insurance company and saying, give me a guaranteed income for life. The drawback to that is you've given away control of your money. The benefit is you will never run out of your money. So you can have income for life or the term that you've selected. Variable annuity is another option. It's very similar to the annuity option above, except you could buy an annuity that gives you the option to actually withdraw the money out. So just say, for example, you're contributing to your Canada pension plan and you get to retirement, and 3 years in, you decide you want to take your money all out for whatever reason, you have the option to do that. Whereas in your CPP, you don't have the option to do that like the annuity above. So the variable annuity gives you a little more flexibility, but also you can have income for life. You can also use life insurance that you could borrow against or withdraw money out of the cash value in your life insurance during the market correction. So when a market correction hits, instead of taking money out at a negative 10%, maybe you go into your life insurance that is not experiencing the same results. And the final one here is a reverse mortgage or a home equity line of credit. Probably the most underutilized strategy out there. It's tax-free money, and a lot of people think reverse mortgages are bad words. They don't look into how they could use a HELOC, maybe taking money out of a home equity line. It's tax-free money. Take the money out, use that money during the down times, and then wait for the market to recover and then withdraw the money out. Can be a very effective strategy. And also, you could use the death benefit strategically with taking money out of a reverse mortgage or a home equity line. Whereas if you took $200,000 out, but on the flip side, you had $100,000 or $200,000 death benefit, you can have the death benefit replace the money that you've taken out of the house at any time. So now you can enjoy more of your assets. So if there's any of these strategies you'd like to discuss in more detail, reach out to one of our advisors at IBC Group, and be sure to follow our YouTube page as well. Thank you.
IB Canada Group, your independent authority for information on the infinite banking concept.